Buying stocks isn't hard. What's challenging is choosing companies that consistently beat the stock market. That's something most people can't do, which is why you're on the hunt for stock strategies. The below strategies will deliver tried and true rules and strategies for investing in the stock market. Welcome back to another exciting video from the Investing Circle. Today's video is about the 5 strategies for investing in the stock market. Before we start the video, please like, subscribe, and press the bell icon. Let's get started. Number 1. Check your emotions at the door. Success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get other people into trouble in investing. That's wisdom from Warren Buffett, chairman of Berkshire Hathaway, and an oft-quoted investing sage and role model for investors seeking long-term, market-beating, wealth-building returns. Buffett is referring to investors who let their heads, not their guts, drive their investing decisions. In fact, trading over activity triggered by emotions is one of the most common ways investors hurt their own portfolio returns. All the stock market tips that follow can help investors cultivate the temperament required for long-term success. Number 2. Pick companies, not stocks. It's easy to forget that, behind the alphabet soup of stock, quotes crawling along the bottom of every CNBC broadcast, is an actual business. But don't let stock picking become an abstract concept. Remember, buying a share of a company's stock makes you a part owner of that business. You'll come across an overwhelming amount of information as you screen potential business partners. But it's easier to home in on the right stuff when wearing a business buyer hat. You want to know how this company operates, its place in the overall industry, its competitors, its long-term prospects, and whether it brings something new to the portfolio of businesses you already own. Number 3. Plan ahead for panicky times. All investors are sometimes tempted to change their relationship stats with their stocks. But making heat-of-the-moment decisions can lead to the classic investing gaffe: buying high and selling low. Here's where journaling helps. Chamomile tea is a nice touch, but it's completely optional. Write down what makes every stock in your portfolio worthy of a commitment, and while your head is clear, the circumstances that would justify a breakup. For example, why I'm buying. Spell out what you find attractive about the company and the opportunity you see for the future. What are your expectations? What metrics matter most? And what milestones will you use to judge the company's progress? Catalog the potential pitfalls and mark which ones would be game changers and which would be signs of a temporary setback. What would make me sell? Sometimes there are good reasons to split up. For this part of your journal, compose an investing prenup that spells out what would drive you to sell the stock. We're not talking about stock price movement, especially not short-term, but fundamental changes to the business that affect its ability to grow over the long term. Some examples. The company loses a major customer. The CEO successor starts taking the business in a different direction. A major viable competitor emerges, or your investing thesis doesn't pan out after a reasonable period of time. Number 4. Build up your stock positions with a minimum of risk. Time, not timing, is an investor's superpower. The most successful investors buy stocks because they expect to be rewarded via share price appreciation, dividends, etc. over years or even decades. That means you can take your time in buying too. Here are 3 buying strategies that reduce your exposure to price volatility. Dollar cost average. This sounds complicated, but it's not. Dollar cost averaging means investing a set amount of money at regular intervals, such as once per week or month. That set amount buys more shares when the stock price goes down and fewer shares when it rises, but overall, it evens out the average price you pay. Some online brokerage firms let investors set up an automated investing schedule. Buy in thirds. Like dollar cost averaging, buying in thirds helps you avoid the morale-crushing experience of bumpy results right out of the gate. Divide the amount you want to invest by 3, and then, as the name implies, pick 3 separate points to buy shares. These can be at regular intervals, or based on performance or company events. For example, you might buy shares before a product is released and put the next third of your money into play. If it's a hit or divert, the remaining money elsewhere if it's not. Buy the basket. Can't decide which of the companies in a particular industry will be the long-term winner? Buy them all. Buying a basket of stocks takes the pressure off picking the one. Having a stake in all the players that pass muster in your analysis means you won't miss out if one takes off, and you can use gains from that winner to offset any losses. This strategy will also help you identify which company is the one, so you can double down on your position if desired. Number 5. Avoid trading over activity. Checking in on your stocks once per quarter, such as when you receive quarterly reports, is plenty. But it's hard not to keep a constant eye on the scoreboard. This can lead to overreacting to short-term events, focusing on share price instead of company value, and feeling like you need to do something when no action is warranted. When one of your stocks experiences a sharp price movement, find out what triggered the event. Is your stock the victim of collateral damage from the market responding to an unrelated event? Has something changed in the underlying business of the company? Is it something that meaningfully affects your long-term outlook? Rarely is short-term noise relevant to how a well-chosen company performs over the long term. It's how investors react to the noise that really matters. Here's where that rational voice from calmer times in your investing journal can serve as a guide to sticking it out during the inevitable ups and downs that come with investing in stocks. That's all for today. Thanks for watching the video. If you enjoyed it, please like, share, and subscribe to our channel for more exciting content.